Good morning. Welcome to the Tortoise Capital Weekend Review, Merry Christmas edition. We have a market that is in bullish normal conditions. On an annual basis, using the weekly RSI 14, we have a score of 85 overbought. On an annual basis, short term, we are in neutral on a 10-day NDX at 66 out of 100. Looking at the market mosaic, we have price with respect to the 200-day moving average is green bullish, and the slope of the 50-day moving average also at green bullish. The risk index is the 30-period moving average of the VIX divided by the 10-period. A score of 1.0 is the boundary between risk on and risk off. It's reading at 1.092, so we are well into risk on. Taking that score and looking to the last 5,000 trading days for context, we compute the risk Z, which is at 0.60 or 0.6 standard deviations above the long-term average. This is a 90-day histogram of that indicator. You can see we've made a double bottom and then a rising lows, and we pulled back just a little bit from about 0.75, so we're still well above the zero line. This is favorable condition for swing trades. This has recently gotten as high as 1.5 in the past, so there's still more room to grow. So we're cautiously optimistic on the long side. You can see the blended monthly rebalancing holdings with the next reevaluation due on or about 1 January, and these are the current winning positions as of closing prices on Friday. Theoretical exposure of ETF2 remains at 90%. Just a quick look at the ETF portfolios for blended monthly rebalancing, and we have the Dow 30 leading the way with the U.S. Tech in second place. The alternate asset classes of treasuries, real estate are in cash position because they are below their 4-month moving average, as is Latin America, which is the weakest of the lot. In ETF 32, which expands that data set a little bit wider, again, you'll notice just a handful of things in the cash and strong positioning among the basic sectors like capital markets, metals and mining, transportation, home builders, oil and gas. So that's all looking strong inside the U.S. In ETF Max, this is a examination of the top 1,000 or so ETFs, and also sorting by the blended monthly score. I add the 1 week and the 1 month so that I can see what these key leaders are doing. There are times when you get a winning position that then has a short-term pullback and then a resumption, a buy-on-dip opportunity, which is like what we're seeing in the China Tech ETF. So it's been exceptional on the longer term. The intermediate term, there was a pullback, and that looks like that was seen as a buying opportunity. So I think there's more room to grow in China Tech, and then also the second China Tech as well. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back, 40, 50, 60. The horizontal red lines are support levels that used to be resistance levels on the way up, and which would act as price targets in a ladder were this price to collapse. But we can see that the slope of the 10-period regression line and channel is up. The 30 is strongly up. You can see right here that is at a score of 0.425. This is the boundary, by the way, of 0.40 of an exceptionally strong 30-period slope. So this is now officially an exceptionally strong move, meaning that's more than 1 standard deviation above the long-term average. And so this now has me careful and cautious about how I'm managing my stops. I'm still participating in the upward movement, but I'm also respecting that this is now an exceptionally strong move, and I want to preserve more of that win than were this just a regular move. You can see the last time that it got up around 0.35 and stayed there for a long while. This was a really long, strong move right here. And then when that rolled over, you see we get this sideways and even a pullback. And so that's my concern here. So we might see some of that leveling off going into the new year. You can see that price is still comfortably above the 200 period moving average. You see the jaws of MACD histogram are still open to the upside. We're well above the zero line. We've spent most of the last 90 days in the overbought condition as this bull market continues to march along. It's been almost 15 days since we've had our last significant pullback, and then the previous one. Both of those were just marginal blips, and those are really buy on dip opportunities. So you can think of this as having at least two legs up on this move. And so I see two, and I'm hoping for a third one to support the long side positions. So again, cautiously optimistic here. Quick look at the ETF2 regions. Only Latin America on a cash signal, and so we remain at 90 and 10 in the theoretical model. The U.S. at 72 is stronger than EFA at 63. Inside the U.S. it is tech, then large caps, mid caps, then small caps. U.S. large and tech are the two strongest sectors. Latin America and Japan the two weakest sectors. Everything in financials, industrials, and technology looking strong. Some laggards here in staples, utilities, and healthcare, so some room to grow there. World market model, everything in the U.S., less the Dow now above average. Mixed bag in Asia. France looking strong in Europe. Brazil clearly leading the way along with commodities and oil. ETF top 30 from the ETF2 system. This again looks at a form of momentum. I like to investigate ones that are green on strength and white on consistency. White on consistency means that it's above average over the last 10 weeks, and then the green on strength means it's starting to accelerate its outperformance. So metals and mining, the Euro 50, retail, and banks and regional banks all looking like opportunities. Clear leaders, oil, home builders, and oil and gas production. ETF liquidity report. These are the top 30 by average daily dollar volume, and you can tell by ATR percentage the degree to which they are excellent for intraday trading. Those in the green are exceptionally volatile intraday, and they make very nice trading candidates because they are both liquid and volatile. So Brazil, gold miners, oil and gas, banks, and the VIX as an example. Shifting now to the daily. So a handful of good channeling signals. Many in the auto framer test out well. Some 5DDs here in the Dow for McDonald's, Johnson & Johnson, and Pfizer will be of interest. I'll be marking those up. And sharing those trade frames, the setups in the chat room. Looking at ETF 30, just a handful of mechanical signals, some frog quality numbers greater than 3 signaling. On the daily pinch and stretch, so the first set, price stretched above the river. This is how many standard deviations compared to their own history they are stretched above the Bollinger Band 30, so above their river. So Caterpillar, metals and mining. These are typically the big percentage winners on swing trades, and the exceptional stretch gives you the alert that that's an unusual condition. So I play that in 2 different ways. When I frame that trade, I look for continuation patterns on resumption of buying, or I start looking for reversions to the mean trades. Certainly I'm looking when they're in the green to make sure that I've locked in the gains if I've already participated on the way up. The negative Z stretches, it's the same thing, but now to the downside. You see there's only two utilities and real estate that have stretched below their 30-period Bollinger Band mean. The most expanded pinch boxes, these are the ones where there has been a sustained move over time that has caused the river to get wide, and so the wider the river, the stronger the intermediate term move, and the more pronounced and exaggerated that move would be. These are all the ones that are in that category. You see the strength in the Dow has caused its river to get extremely wide. The most compressed pinch boxes to me are also very interesting because this supports the Z3 pinch frame of reference. So oil and Apple, both more than one standard deviation of compression compared to their long-term average. So that's going to be a exceptionally narrow river, which gives us confidence to play the breakouts because it's a reaction against that exceptional sideways type of movements. The super pinches are those that are not only very pinched on the Z-score basis for the narrowness of the river, but also where they're the four regression lines, the 10, 30, 90, and 270, are all exceptionally pinched together. And that means that there's unanimity about what fair value really is. And so when you combine the all of that consensus and a very narrow range on the river, on the width of the river, you have a prime condition for breakouts that can last well into the swing trade time frame. So Apple is on my short list for that reason. So this is an example of Apple. We're taking a look at that Z3 pinch. You can see that the width of the river is very narrow compared to its longer term average, and you're getting a Z3 pinch. You see the Z3 patterns pinch. The last time it pinched like that was just prior to a big breakout. Last time before that, this pinch led to a breakdown. So all of these are tradable moments that come out of these tight pinches. At the same time, you see the RL270, the long-term price of buy and holders, the 30, the 10, the 90, all of these are very tightly compressed, and so you have consensus agreement about the current fair value. So breakouts from like the Z2 on this line, I would play a continuation pattern. I would immediately buy any breakout above the previous high to go along with the stop below the Bollinger Band mean. So just a couple dollars of risk. And then breakdowns, if it left the river, this is where I would be looking to get short because that's using the collapsing dragon. This is the swing low in the dragon, so a breakdown below 171 would be an auto short, and then I'd be looking at a return to about 158. So that's an example of how we use that pinch and stretch to find things that are the super pinch are ideal in my view for exactly that kind of breakout from congestion zone. Now what I want you to notice is oil, which is also very compressed pinch box, but it is not on the super pinch list, and the reason for that, this is oil. Let's zoom over here to the side so you can see. Here you have a very narrowly compressed river, but when you look at the regression lines, you see the 270 is way out here, so it's already proceeded well above, pulled away from that long-term value from the RL270. So you got the 90, the 30, and the 10 all tightly compressed, but the fact that this has already pulled well away from the 270 says that this is not a super pinch. It's pinched, but it's not a super pinch. A super pinch would have happened exactly back in here. You have a very narrow river. See how the Z3 lines are pinched together as well. You have the 270, the 90, the 30, and the 10 all in this nice tight compression range down here around $9.70. Oh, we can't really see that, sorry. So over in here, when we go back a little bit, you see a pinched river, the 270, the 90, the 30, and the 10 all nicely clustered together. That's around $9 actually and 60 cents. And then the breakout occurs out of the river, and you can get long in here with a stop below the dragon belly, so not much risk at all. And then you notice that has moved from 960 all the way up to 1160, and that's a 22% move on that swing with hardly any look back except maybe just one. And if this was enough to get you out, a resumption of this move when it leaves the river again allows you to get back in and participate in that very nice swing move. So super pinches on daily charts are my primary way of being prepared for the next leg up or down of a big swing move. And then those can be played tactically in addition for intraday leverage and using the turbo and core technique. So to review, for me, this daily pinch and stretch report, and I'm just using the Dow 30 and the ETF 30 symbols, this is a reliable way of finding where symbols are in the life cycle between being very pinched and very stretched on a swing trade basis. That's how we see sector rotation occurring and swing trade candidates unfolding. This is a very useful tool for me to find exactly those kinds of moves. The auto framer is a nice way to find those one-day postures. Like here's in utilities is a 10-to-1 reward to risk ratio compared just to a retest of the swing high. So here's a pretty remarkable move in utilities, for crying out loud. We've got from a pinch, a move down from 55.5 all the way down to 52. That's quite a move in utilities. And the sell-off occurred, and then you have Friday going into the weekend, a higher low, a narrower range, and 1, 2, and now I'm ready to buy around 52.70 on the second day of momentum, with the targets of looking at the I think Z2, the edge of the river was right about here, and then a Bollinger Band mean. Even if you just took the previous belly of the dragon and looked at around 53.25, even that sets up a nice reasonable initial target just back to the dragon. And then certainly any failure below here we'll be looking at even more. But there's so much money tied up in utilities from defensive plays, and I really think that folks are going to be looking at this as a way to buy a stream of income, an income generator, buying yield on sale. And it's down from a swing high of 57.5 down to 52.5. That's really buying a bond on sale. So I would expect to see a reversion back to the mean, and even if we just took the middle of this dragon hump to the dragon belly and place this around target around 54.5, which is not too far from the RL30, that's a reasonable upside target. So I think utilities are especially interesting now on a swing trade basis. So I believe I'm going to be buying them next week. Now back to our reports. So that's just one way you can use the auto framer concept as a way to find large moves away from a 10-day high and then followed by range compression. So you get a max pain range compression. Treasuries are interesting. That's a 9-to-1 reward to risk. We're going to have to take a look at that one too. Yeah, this is kind of a no-brainer in terms of trade location. You've had 3 days where failure to fail further. This was probably the better entry, but I still think you can get a reasonable entry here. And then looking at a return up to around 126, back into the middle of this range in here. So that one looks reasonable to me. I'd even go looking for the 30 period as the trader's fair value, 126.50. This is the trader's price, the RL10. This is the trader's fair value, the 30 period regression line. And treasuries have had a nice run, as you can tell by the slope of the RL270. So this, we are equivalently in the same position here that you saw back here. an excursion down to Z minus 2, 1, 2, 3, and then look at that move from 122.90 up to 127. I mean, that's $7 on 120. That's about an 8% move. So I think treasuries, utilities, very well postured here for swing traders out there. So those are just the top two in the auto framer. Everything in the green is based on reward to risk ratios that are better than 2 to 1. So that's between the auto framer and the daily pinch and stretch, not to mention the tactical summaries, plenty of swing trade ideas. The long grinding bull continues. We're still on the edge of the river, and the river is widening. The 90 and the 30 are both out of the river, so this has been an exceptional move, and we've seen that already from the slope of the 30-period regression line when it left the river. So this is one where if there is such a thing as easy money, and I don't think there is, it's easier when the 30 bottoms out near the base here around Z minus 1, that was down around this area, and then starts to roll back up, and then the 90 was right in the middle of its SD river around 0, and that move has been from 245 up to 265, and in that time the 30 has continued to get better and now has left this yellow river, and the 90 went from the 0 line and is now at Z 1.5, and then there's been a little pullback the last 4 days. So this is an opportunity for a resumption or just a reversion back to the middle of the river. But this is a natural cooling spot. I'm thinking there's one more tactical bump left, and I'll be playing it that way. So that's everything that I wanted to cover on the report. We're already 20 minutes in. Wishing you all a safe and Merry Christmas. Wishing you peace and joy and goodwill towards men. Take good care and embrace your fellow man.